Hello and welcome. Today we are going to discuss strategic ETF investing for long-term wealth creation.
Picking individual winning stocks is an exhausting process with a high failure rate. To succeed, you must monitor hundreds of moving parts. Exchange-traded funds, or ETFs, snap that chaos into a single organized unit. These funds combine the broad diversification of a mutual fund with the real-time tradability of a stock. You can buy or sell them on the exchange at any point during the trading day. This scorecard highlights the structural shift. Active mutual funds calculate a single price at the end of the day, charging higher fees for human management. ETFs offer real-time pricing and lower expense ratios because they simply track a preset index. Buying an ETF is only the first step. The specific index that the fund tracks is the actual driver of your long-term wealth. The choices span domestic blue chips, agile mid-cap innovators, international technology giants, and physical commodities. The century challenge is matching these specific economic indices to your personal risk tolerance and time horizon. The Nifty 50 ETF is the standard domestic anchor. It serves as the primary barometer for the Indian economy, tracking the country's largest listed entities. This index is a collection of 50 blue-chip companies across banking, IT, and consumer goods. These are massive corporations with the balance sheets to survive significant economic downturns. However, the Nifty 50 carries concentration risk. Weighted by market cap, the top 10 companies dictate 56% of movement. The Nifty 500 ETF offers a broader alternative, capturing 95% of total market capitalization. Expanding to 500 companies dilutes risk, dropping the top 10 weight to just 32.5%. While the Nifty 50 is a reliable starting point for beginners, the Nifty 500 captures deep-rooted economic growth without over-relying on a handful of megacorporations. Many investors look for a sweet spot, the stability of large-cap companies combined with the higher growth potential of mid-caps. The Nifty Large Mid-Cap 250 Index uses a rule-based framework to solve this. It maintains a strict 50-50 division, putting half your capital into the top 100 large caps and the other half into the next 150 mid-caps. For those seeking aggressive alpha, the Nifty Small Cap 250 ETF tracks the bottom half of the top 500 companies. Small cap investing involves extreme volatility. These companies often have niche business models and are in the early stages of market penetration, leading to unpredictable swings. These indices prioritize mathematical optimization and growth over stability, which requires a long-term horizon to withstand market downswings. The Indian equity market is heavily dominated by traditional banking and IT services. It currently lacks a significant presence in cutting-edge sectors like artificial intelligence and deep tech. US-based ETFs tracking the S&P 500 or NASDAQ 100 provide a gateway to these global technology leaders. These indices are highly concentrated. In the NASDAQ 100, the Magnificent Seven, including Apple, Microsoft, and NVIDIA, make up over 62% of the total weight. Beyond technology exposure, US ETFs offer a second benefit for Indian investors, a hedge against currency valuation. Historical data shows the rupee depreciating against the US dollar by roughly 40% every 10 years. This creates a double-engine return. Your total yield equals the US market return plus the gain from the rupee's depreciation. If the market rises 10% and the rupee drops 4%, your absolute return in local terms is 14%. Allocating to US ETFs serves as a mechanism to preserve your domestic purchasing power against a weakening currency. Gold ETFs provide a pure monetary asset. They act as a safe haven and an inflation hedge when geopolitical risks cause panic in the equity markets. Silver functions as a high-growth industrial commodity. Over 50% of its demand is driven by industrial applications, including solar panels and electric vehicle infrastructure. Choosing the correct index is only effective if the underlying ETF is technically sound. This is tracking error. Because of fees and costs, an ETF's actual return slowly drifts away from the index it follows. High expense ratios and low assets under management accelerate this drift, leading to higher impact costs when trading. To protect your compounding interest, you must prioritize ETFs with the lowest tracking error and the highest assets under management. There is no universal best ETF. Success depends on selecting the right combination of indices for your specific financial situation. A risk-averse strategy anchors the portfolio in the Nifty 50 and Nifty 500. This provides exposure to standard economic growth with lower volatility. A strategic optimizer might use the large mid 250 as a core holding, while allocating a smaller percentage to the small cap 250 for more aggressive growth. For those concerned with inflation and currency drops, U.S. ETFs and precious metals provide necessary protection for your global purchasing power. Remember that taxation rules vary across these categories and will impact your final net yield. Long-term wealth creation requires you to diagnose your risk appetite first. From there, you can use these 6 ETFs as precise instruments to build a high-performing financial engine.
For more such videos, subscribe to our channel and stay ahead in the world of finance, investing, and wealth creation.